Before this video really starts, I want you to picture your entire Bitcoin budget, whatever number you have in mind. Now imagine it dropping by 60% within 90 days of investing in it. How does that feel? If your honest answer is that you probably would sell some, then the strategy most people are recommending to you right now would almost certainly cost you your money. Not because it's bad math, but because it is the wrong math for you. Hi, I'm Dr. Hunter Allbright, Chief Revenue Officer at SALT, former banking executive and professor at the University of Colorado Boulder. Now, for nearly 30 years, I've worked at the intersection of credit, analytics, and emerging technology. From leading global portfolios in traditional finance to building Bitcoin-backed lending infrastructure today, this channel is about helping you think clearly in a noisy world, understanding Bitcoin through structure, risk, incentives, and long-term value. So stay with me through to the end. I'm going to give you a simple 3-question framework that makes this decision obvious. Most people never think to ask these questions, but by the end of the video, you will. If your goal is to accumulate Bitcoin, maybe even reach one full Bitcoin, there's a question you'll eventually face. Should you invest all at once or spread it out over time? This is the classic debate. Do I dollar cost average my way in or buy lump sum investing? And the answer isn't emotional. It's mathematical, but it's also psychological. And today we're going to break this down. What DCA actually is, what lump sum investing really means, which approach historically performs better, and which one most people can actually stick with. Now, because the fastest path to one Bitcoin isn't just about math, it's actually about behavior. So let's start with clarity. When somebody says, I want to get to one Bitcoin, what I think they're actually saying is I want to accumulate a fixed supply asset before it becomes harder to obtain. And that's a scarcity-driven goal. There will only ever be 21 million Bitcoin. So your strategy determines how efficiently you move towards that target. Now, let's define the two different approaches. Lump sum investing means you deploy all available capital at once. If you have $50,000 allocated to Bitcoin, you invest it immediately. No waiting, no staggered purchases, no schedule. You get full exposure as soon as you buy the Bitcoin. The benefit, if the price rises after you invest, you benefit fully. Now the risk, if the price drops right after you invest, you feel that volatility immediately. It's simple, it's decisive, and it's high exposure. Now, dollar cost averaging means you invest a fixed amount, but at regular intervals. So, for example, you could be investing $500 every week, or $1,000 every month, or any consistent schedule that fits your budget, regardless of price. And when price drops, you buy. When price rises, you buy. Over time, you smooth out your average cost. DCA reduces the timing risk, but it also delays full exposure. Historically, which performs better? Let's talk about the math. In traditional markets, including equities, studies have shown consistently that lump sum investing outperforms DCA roughly 2/3 of the time. Why? Because markets tend to rise over long periods. If the asset has a long-term upward bias, getting invested sooner increases your expected returns. Bitcoin historically has had an upward bias over a multi-year period. So purely mathematically, if you have the capital ready, lump sum investing has historically been the higher expected value move. But that's not the whole story. Bitcoin is not a low volatility asset. It could drop 20% in a day, 40% in weeks or months, and up to 60% or more in major drawdowns. If you lump sum at the wrong time, you may experience significant drawdowns quickly. And here's the problem. Most investors don't fail because of math. They fail because of emotion. If a 40% drop causes you to panic and sell, then lump sum investing was not the optimal strategy, regardless of the historical averages. Now, there's a psychological advantage to DCA. DCA does something powerful. It removes the need to be right today. You don't have to predict the top, the bottom, the perfect entry. You are committing to accumulation over time, and that consistency builds discipline. It also reframes any volatility. Instead of fearing price drops, you actually welcome them because you're buying more at lower prices. For many people, DCA increases the probability they stay invested over long periods of time, enough to benefit from long-term adoption and appreciation. And staying invested is what matters. Now, there is a third option, and it's often the most rational. If you have capital available today, you can deploy a portion immediately and DCA the rest. For example, if you have capital, you can invest 50% now and DCA the remaining 50% over the next 6 to 12 months. With this approach, it gives you partial immediate exposure, reduces regret risk, maintains discipline, and lowers emotional pressure. It's not an all or nothing. It's strategic exposure management. Now, let's bring it back to the goal. If your objective is to accumulate one Bitcoin as efficiently as possible, then speed depends on two factors: your available capital and your conviction level. If you already have the capital and a high conviction, then mathematically, earlier exposure increases the probability of reaching that goal faster. If you're building capital gradually, then DCA isn't a strategy, it's a necessity. Most people earn income over time, so naturally they accumulate over time. And in that case, DCA aligns with cash flow reality. Your time horizon changes everything. If your horizon is 3 to 6 months, timing matters more. If your horizon is 5 to 10 years, timing matters less. Over longer horizons, entry precision becomes less important than participation. And historically, Bitcoin's most successful hodlers were not the best timers. They were the most patient. Here's something that most people don't consider. The biggest risk is not choosing DCA or lump sum investing. Actually, the biggest risk is overexposure. If you invest more than you can emotionally tolerate, volatility will control you. If you size your allocation appropriately, you can withstand drawdowns. So the real question isn't what is the fastest way to 1 Bitcoin? It's actually what's the most sustainable way for me to accumulate without quitting? Because quitting resets the clock. So here's a simple decision guide. If you have capital ready, if you have high conviction, and you can tolerate volatility, lump sum investing has historically higher expected returns. If you are building capital over time, prefer lower emotional stress, and want to remove timing anxiety, then DCA increases consistency and discipline. If you want balance, then combine both. But remember, no strategy guaranteed speed. The only guaranteed accelerant is increasing income, increasing your savings rate, and maintaining a long-term conviction for investing. Your strategy matters, but your behavior matters more. DCA and lump sum aren't enemies, they're tools. The fastest path to 1 Bitcoin isn't about predicting the perfect entry. It's actually about clear goals, proper sizing, emotional discipline, and long-term thinking. Because in volatile assets such as Bitcoin, survival and consistency beat precision. Now, if you found this helpful, we encourage you to subscribe to the Bitcoin Advantage. We focus on frameworks, not hype, so you can build conviction the right way. I'll see you in the next episode.